Okay, everybody. I have right about 6 o'clock or a little bit after, so we can go ahead and get started. And thank you for joining me tonight. If you can hear me, there's a couple of you that I can see on camera. If you can hear me, give me a thumbs up in your screen. Okay, perfect. And also give me a thumbs up if you have the market outlook presentation on your screen as well right now. Okay, perfect. Thank you. All right. So let's see here. Okay. All right. So again, thank you for joining me tonight. My goal in these, and we've done these a couple of times now, both as topical quarterly presentations through a Zoom call like this, but also we've done kind of an annual market outlook right away in January. And so that is our installment for this year to talk a little bit about 2025 and perhaps what lies ahead. I want to mention that I will take questions. I always ask this, and I'm not sure that anybody usually takes me up on this, but there is my email address. So the best way to ask me questions as we move along is to send me an email, and then I will address that towards the end of the presentation and discuss through that a little bit. It's always very helpful for me to know what you're wondering about, what your reactions are, and just what's on your mind. Now, if you don't have a question tonight that we can discuss during the presentation, I always do value your feedback. So feel free to shoot me an email as well, letting me know whether this is helpful or is it that you're looking for different information or presented differently. I want to make sure that these are as helpful as possible for you and just your outlook on the markets and the state of the economy itself. Okay, so let's jump right into it. 2024 was certainly a significant year in the market, and we're going to talk about that a little bit and as a kind of a foundation for where we're headed here. Now, I did get some feedback previously when I think it was midway through the year, we did kind of an impromptu call like this. And the reason for that call all of a sudden is because we had faced a significant downturn in the market over about a 5 day period of time. So sometimes I like to do these to get a message out to all of you to just talk about what's going on and where I think we're headed in that market downturn. Interestingly, as we did that call, we were right on the turnaround point where the market did turn around and basically wiped out all of the losses within a fairly short period of time. I would like to take credit for that, but as you know, I had nothing to do with that whatsoever. But again, that was a way to give some perspective. I did get some feedback that a lot of what I said that night are things that you've heard me say before. But I was trying to give somewhat of a perspective on some of the downward pressure on the market. And frankly, it's downward pressure that I don't necessarily think has gone away. And that brings me to talk once again about money supply. And you don't get a lot of this out there with a lot of analysts, but money supply is really huge because I think it not only explains a lot about what has happened over the last 4 to 5 years now, but it's also going to play a role in where we're headed in the future. I've shared this graph a number of times, both individually in my office and even during calls like this. So this is the M2 money supply chart. M2 is an economic term where basically we take checking and savings, money market accounts, basically all forms of cash throughout all banks, financial institutions, etc. And it gets graphed out on this chart. And by the way, There is going to be new stuff tonight. So I'm starting with something that we've talked about several times, although I've updated this chart. We are going to get into some new things tonight to think about. So just in case I was losing some of you already that are thinking, he's talking about the money supply chart again. Bear with me, but this is an important issue. So you look at this graph going all the way back to the late 50s, and you can see that the money supply has steadily been increasing over time. And it's okay for the money supply to be increasing over time. Why? Well, our population is going up all the time. And as we have more and more people getting jobs, spending money, participating in the economy, we do have to inject more money into our system just to allow for population growth. However, you see it steadily increasing again, mostly because due to population increase. But then in 2020, which it's amazing how time flies, but back in 2020, so basically about 5 years ago now, we were just starting to talk about the coronavirus and about COVID, and things really started to blow up in March and April of 2020. So, what we did is we sent a lot of people home from their jobs, shut down workplaces, shut down various other things within our society, within our economy. And we sent people home as a way to try and choke out the virus. And the problem with sending people home like that is if they're not working, if they weren't able to work remotely, we can't send people home without a paycheck, expecting them to continue to make their mortgage payments, which is good for banks, and also buy food and heat their homes and all of the things that we need to spend money on a regular basis. So we created stimulus packages injecting cash not only to you directly in the form of various checks that we sent out, but mostly the stimulus programs were designed to put cash into the hands of employers who can then keep that cash as long as they kept people on payroll. And so you see this huge jump. This is about a 40 to 45% jump in the money supply because we created new cash, we injected it into the economy, and it allowed us to continue to feed ourselves, clothe ourselves, shelter ourselves, and make mortgage payments, etc. Well, when we have a huge influx of cash like that, you don't even have to have taken an Econ 101 course, but when you inject brand new cash that never existed before into the economy, and just as a way to circulate more money into the economy, then that is a classic way to create inflation. There's no better way to create inflation than to do something like that. Now, you look at this chart, and this is going back 60, 65 years, and we've never done anything even remotely close to this. So this was highly unusual, and it's why we're still talking about this today. So you put that much cash into the system, that's going to create inflation, which is exactly what we did. We'll talk about that in a moment. But you do see that the money supply, as things settle down, started to come down. But now we're seeing it turn again, and we're seeing a general uptrend in the money supply. Now, if I eyeball this and I continue this line all the way to where we are now, the tip of that line is not that far off from where we were going to be if we just continued on our trend here. So that's the good news. But the money supply chart still shows inflationary pressure because we are ahead of where we would have been if COVID never happened. We continue to have this money circulate in our economy, which is good temporarily. But we did go through a 12-month period of time where we had 9.1% inflation. Now, that 9% inflation rate has come down under 3%, but we're still not to where we want to be. Again, we'll talk about that in a moment. But this is all of really what happened and how we got into this situation. Because we have inflation. In order to combat inflation, what do? We raise interest rates. When you raise interest rates, That does put pressure on the economy because generally less homes then sell. We sell less cars because that's tied into the financing markets. And one of the biggest entities that are hurt by high interest rates resulting from inflation, which results from this money supply chart, is businesses. Businesses borrow a lot of money. And yes, the government also borrows tons of money. We'll get into that as well. So this is by way of review, but I'm putting this up here again as a reminder of how we got to where we are. Now, that was the money supply. So let's talk about inflation. And this is a graph that charts inflation as represented by the Consumer Price Index. What's the Consumer Price Index? Well, basically, it's a measure that the government puts a number out on a monthly basis, telling us of all of these things that you see on here: energy, clothes, housing, vehicles, gas, food. There's a collection of things that they look at, including all these things and more, that they look at the prices of all of those things and then report it on a month-to-month basis. And that is your Consumer Price Index. So you see a lot of jumping around here going back to November of 2004. Here is the jump that really included the 9.1% 12-month increase in inflation. So this is the problem that we created by pumping all of that cash into the marketplace. Inflation has come down quite a bit. And even here, and this was during 2024, you see this slide down here. This is where we got all excited mid to late last year about how much interest rates are going to fall. So the federal funds rate, which is the interest rate that the federal government controls, which this is the interest rate where banks generally borrow other money from banks and borrow from the government. This is the interest rate that those banks pay as they borrow money. So as it goes up or down, it filters through the money that they lend to us. If they're borrowing at a lower cost, then they're going to lend at a lower cost. If they're borrowing at a higher cost, then they're going to lend at a higher cost. So all of that's to be said within the interest rate market. And as it relates to inflation, we saw a decline here, which the decline in inflation to get to this point had everybody all excited that this inflationary mess that we created is now over and continuing to get better. The federal government wants to see this line get down to 2 to 2.5%, maybe about 2.3, 2.4%. That's their goal. And it looked like this slide here was getting us well to that goal. And so that's why we were so excited, because that allowed us to lower interest rates again, because interest rates combat inflation. But if inflation isn't as much of a threat, then interest rates can come down. And that's what was happening. Or we were talking and getting all excited. We were lowering interest rates. The federal funds rate got up to over about 5.25%. Now we've had a couple of reductions, so we're down about a full percentage point. But we were talking about maybe a total of about 2 percentage points all in from the 5.25% and eventually getting down to 3 to 3.25%. However, towards the end of last year, all of a sudden we saw a little bump here. It doesn't look like much, but for a line that's supposed to be trending down, this little bump at the end is not what they wanted to see. So they've gone from giving us the expectation of 4 interest rate reductions in 2025. They've now pared that back to probably 2 interest rate reductions. All of this doesn't sound like a big deal, but let's talk about how this relates to the stock market. The stock market loves low interest rates. If it was up to the stock market, interest rates, you'd always be able to get a 3% mortgage. You'd always be able to get a 3.5, 4% car loan. The reason the stock market loves that is because that moves business. That makes business happen because borrowing costs are cheap. And when borrowing costs are cheap, a lot of money exchange hands because people are buying more cars or buying more homes. Businesses are expanding because they're borrowing more money, all because their interest rate expenses have gone down. This little blip here kind of took a lot of air out of that balloon. And so for the time being, the Fed has now come back and said, well, maybe only two interest rate deductions of a quarter point each in 2025 instead of four more, which is what we are expecting. The market wasn't thrilled about this, and so it had some negative reaction to this. Now, the interesting thing about the CPI is we always get new data once every month, and actually, new data comes out this Wednesday on the 15th. If we see a big drop in this line again, well, then the market's going to probably love that. And we might go back to talking about three or four interest rate reductions. But this line is huge right now as far as where things go, because it's going to have an influence on the stock market. It's going to have an influence on the economy as well. But I'm explaining this right here because I've described to many of you that inflation is kind of like the campfire when you're out camping in the summer. You're sitting around a nice campfire enjoying it, but now it's time to go to bed. What do? You douse the fire with a bunch of water. Gets all steamy, makes a bunch of noise, bunch of smoke. But you do that enough, then literally the fire is out, or so it seems, until you get up in the middle of the night to run to the bathroom. You look at the campfire. What do you see? Don't necessarily see flames, but you do see an orange glow many times in the campfire, where the campfire is not necessarily out. We have doused inflation with water to try and make this fire go out, but inflation is stubborn. This little bump here at the end of the graph is a stubborn way for inflation to stick around. This is going to be huge to watch over the next 3 to 6 months. Is it going to be stubborn inflation, or is that fire going to go out where when we get up in the morning, that glow is no longer there and we're not concerned about it anymore? A lot of eyes are on this chart, and we'll get new data, not tomorrow, but the next day. Okay. So let's talk about the stock market. Now, if this was an interactive presentation, one of the questions that I would ask you is how many major Wall Street analysts predicted a 25% bump up in the S&P 500 for 2024? The actual answer to that is zero. Nobody saw the 25% bump in the stock market coming in 2024, in large part because in 2023, we had a 20% bump. So we've had two amazing years, especially in the S&P 500 in a row, where this time last year, there was still a lot of analysts talking about recession. They're talking about maybe a down year in the market because we had such a nice bump in 2023 following the really bad year in 2022. But nobody really saw this coming, and that's what makes the stock market so difficult to predict. The stock market is driven by a lot of fundamental data and numbers and charts and facts and all of that kind of stuff. But the stock market is also driven a lot by emotion, how people are feeling. If they're optimistic, they're going to put money in the market. If they're pessimistic, they're pulling money out of the market. And that's in part what happened in 2024. But something, this is kind of new as a conversation with a lot of you, but the S&P 500, what is that? It's a collection of 500 of our biggest companies in our domestic economy in the United States. So many names in the S&P 500 you recognize. Why? Because they're huge, massive corporations. They advertise on TV. They put their names on football stadiums. We see them all over the place. However, 2024 was yet another year of an amazing phenomenon in the S&P 500, which is represented not only in this slide, but in the next couple of slides. I've mentioned a couple times now, the S&P 500 returned 25% in 2024, but there are 7 companies that are significantly carrying all 500 companies on the S&P 500. What are the 7 companies? Most, if not all of us, are familiar with all of these. Microsoft, these are, of course, the trading symbols on the stock exchanges. So Microsoft, Apple, NVIDIA, Amazon, Meta, which is really the parent company for Facebook, Google, and Tesla. So what is this chart telling us? This line up here, 25%, that's the return on the S&P 500 in 2024. However, where did that 25% return come from? Almost 1 percentage point, 1 out of the 25, came from Microsoft. Another 2% came from Apple. Almost 5.5% of the return on the S&P 500 came from one company, NVIDIA. 1.5 from Amazon, 1.33 from Meta or Facebook, 1.3% from Google, and about almost 1% from Tesla. So when you get to this point, that's almost, if I eyeball that, that's about 13.5% that has come from 7 companies, which is over half of the return on the S&P 500. So yes, this is a lot of return here yet, but keep in mind that's 493 companies that put together this return, but that return did not equal the total of these 7 companies. These are the magnificent 7 companies, which if you follow this at all, some of you do, some of you don't necessarily, but so much of the return that a lot of people enjoyed if you had money in the S&P 500 area, the large company area, so much of this is being carried by the Magnificent Seven. Is this a phenomenon that's isolated to 2024? No, this is just a continuation of what we've been seeing for a handful of years now. And this is actually quite unusual. This graph represents each year going back to 1995. And what it's saying is of all of the companies on the S&P 500, what percent of them beat the average return on the S&P 500? So a blue bar represents broad participation. That means that a lot of companies participated in the return on the S&P 500. We haven't had the difference between 7 companies versus 493 companies in these blue bar years. But then it's not unusual to see the orange bars in here where, yes, more of the return is being carried from a small number of companies. But this is kind of the point, especially the last 2 years, where this is kind of ridiculous, where so many companies on the S&P 500 are not even getting close to the average return on the S&P 500 because that return is coming from 7 companies. Now, question is this good news or is it bad news? Well, the good news is actually if it wasn't for these 7 companies, your returns in your portfolios would not be nearly as good as they are. So that's good news that these companies are so dominant because you do own these companies in your portfolios. The bad news is what happens if these portfolios run into some really rough patches and maybe they're not meeting expectations all of a sudden and we see the market tank. I'll pick on Tesla for a moment. The electronic vehicle market is maybe, at least for the time being, not looking to be as strong as we once thought. Now that can change, but as sales in electronic vehicles subside, this could be a lot of market return that gets wiped out in the future. Again, I'm picking on Tesla, but you can apply that to any one of those companies. So we're at an unusual spot here where the last couple of years, those magnificent seven are carrying the market so that so many companies in the S&P 500 are not putting up anywhere close to those numbers. So we are not having broad participation in the S&P 500, which basically means a low concentration of companies is creating a huge amount of the return in the index itself. This is just another way to look at this, where each color on here represents the average weighting in the S&P 500. So again, these are 500 companies, and yet Apple's gotten to be so big that they represent about 7% of the S&P 500 just because they're that massive of a company. Nvidia is getting there very, very quickly. Microsoft's been there for a long time. So these seven companies now represent over 30% of the market value in the S&P 500. Extraordinary. So this is a little bit concerning. There's a however. The however is we have 493 companies actually that are not returning all that much money as part of the S&P 500. And this is only the S&P 500. There's many, 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 many other corporations in our economy, but they're not big enough to be in the S&P 500. But small companies are in the Russell 2000. Mid-sized companies are in the S&P 400, and there's other variations of each of those indices. So what I'm saying in all of this could be good news because eventually I believe more of those companies aren't going to put up the returns that the Magnificent Seven are. But as the economy gets through a lot of what we're talking about, high interest rates, high inflation, record levels of consumer debt, all of that kind of stuff, then as we get broader participation from the rest of these companies, not only in the S&P 500, but the small company indexes have lagged behind the S&P 500 as well. I call those compressed springs. They're springs that are being held back, but once that's released, then they could really return some nice numbers. So there's a lot of areas of the market for investors to be rewarded yet. It's just right now happening in a very small number of stocks. This is something that I watch as well on the S&P 500. This graph isn't, this is the best graph I could find, but this charts the PE ratio on the S&P 500. Okay, what does that mean? Every company has a PE ratio where they take the price of the stock and they divide it by the earnings of the stock. It's a simple formula that represents how expensive the stock is relative to how much money the corporation is earning. So a high PE ratio is an indicator that the stock is expensive. A low PE ratio is just the opposite. It's cheap. It's on sale. It represents value. So over time, the average, if you look at this, and this is going back almost to the beginning of the stock market, you can eyeball this and kind of see the average PE ratio falls in here. Yeah, which is, we'll call that the 15 to 17, maybe 20 range. So basically, if a company has a 15 PE, that means that the price of its stock is trading at 15 times the earnings for the stock. If it has a 60 PE ratio, that means that the stock is trading at 60 times its earnings. So again, simple way to measure whether a stock is expensive or cheap. So the average kind of falls into here. Sometimes we're below that, sometimes we're above that. But the average is maybe in the 15 to 17, 18 range. Right now, but we're still all over the place, and markets drop, which has an influence on PE ratios and vice versa. But what I'm concerned about in the S&P 500 is if the average is, we'll just call it 17. If the average is 17, then right now, the average PE ratio today and the S&P 500 is right around 28. So that means that these stocks in the S&P 500 are really getting expensive. Why is that important to look at? Well, what goes up has to come down. As the PE ratio gets higher and higher, then one of two things needs to happen, or both. Either companies need to grow their earnings significantly to justify their high PE ratio, because as they grow earnings, their PE ratio comes down and puts them more in line to where they should be. Or the stock market has to adjust the price of the stock. So if a company has a PE ratio of 30, but it's not justifying that because of their earnings, then the market will eventually bring down the price of that stock, because generally things will trend in this area here eventually. It'll be above this area, it'll be below this area. But what I'm pointing out to you right now is the general trend with the market run up that we've had over the last 2 years is that the S&P 500 is getting pretty expensive with a PE ratio of 28. Something else to keep in mind on, keep our eye on. Okay, I thought this would be kind of fun is I compiled a list of all of these companies. We abbreviated them for the sake of this slide, but all of these companies, these are Wall Street firms that have analysts that look at the stock market, look at companies, and then they project on a year-to-year basis what they think the S&P 500 is going to be at the end of each year. And so the reason I'm putting this up here was to give you an idea. So the S&P 500 closed today, it looks to me like at 5,836. A lot of these companies are predicting anywhere from 6,500, 6,600, all the way up to 7,000 or 7,100. So if the S&P 500 was at 6,000 right now for easy math, and we'll pick an analyst that's choosing 6,600, that's a 10% increase that roughly a number of these analysts are predicting. So these are nice numbers. And if we go up another 10% or more on the S&P 500 after already going up 20%, followed by 25%, that would be what I would consider to be a very good year in the stock market. So I thought that would be interesting. Am I buying this? Not necessarily, but we'll leave it at that for now. In fact, or we'll kind of go into this. So I'm wrapping up here by talking through what are some of the headwinds that we have with our economy in the stock market, and what are some of the tailwinds that we have moving forward. And there's a lot of new things in here that I'm bringing up to talk about. So headwinds. What are we heading into that's going to make 2025 difficult? Our government debt, I talk about this with a lot of you. Each of the last 2 years, we've added $2 trillion to budget deficits. And that's on top of, just a deficit expansion that we've had. That's real significant. This concerns me. It concerns a lot of you. As we grow our economy, it helps us to handle this debt. I've made that point before. But if we look at this in simple terms, if you as a family in your house, as you continue to take on more and more and more and more debt, now you're not even, if you don't have the income to keep up with that debt, that's going to end poorly for you and your family. And this is something that's concerning with the government. I already talked about market breadth. I want to see more and more companies in the S&P 500, and then even outside of the S&P 500, to be growing their earnings and see more market appreciation in the stock prices of those companies outside of just the Magnificent Seven. We talked about inflation numbers. There's a lot of analysts that I've been reading articles from that are saying we have a ways to go to really have beaten inflation. Yes, inflation was 9.1% at one point. Now we're under 3% or kind of bouncing around there. The Fed really wants to see inflation under 2.5%. And so getting it from, let's say, 2.8% down to 2.3% is probably harder than getting it from 9% down to 3%. So these inflationary embers continue to kind of linger out there. It'll be interesting to see what the inflation report is this week. Interest rates. If inflation isn't going away, if those embers are still burning, interest rates and the reduction of them is going to happen slower than we would prefer. That's a headwind as well. Job growth. Now, we don't have high unemployment compared to historical levels, but so we've had good job growth, but that's we need to pop the hood and look at what's happening there. Again, if this was interactive, I'd ask this question, but where do you think that the largest job growth is coming from in our economy? Is it in the Magnificent Seven? Is it in other places within the technology industry? All sorts of different possibilities. The answer to that question, there are two entities where the vast majority of job growth is coming up from. One of them is healthcare, which that's not too hard to figure out when you have the baby boom generation and 10,000 baby boomers retiring every day. We're going to need more healthcare workers as the baby boom generation continues to age. So, okay, that is what it is. And thankful for healthcare workers. We need as many healthcare workers as we can have. So that's fine. I'm not picking on that. But even more so than healthcare workers, the biggest job growth that's happening are government jobs. We have been continuing to massively expand our federal government, our state governments, our local governments. The government is not the place where we want to be having the largest amount of job growth. We'd rather see that happening in corporations and other entities in our economy. Why? Well, it's not easy to pay for all these government jobs because it comes from tax revenue and various other things that aren't necessarily favorable for the economy. As corporations grow, they take on more employees. That's usually an economic plus. But if the largest employer is expanding our job pool in the form of the federal government, state governments, etc., that's not a good thing, because that's really something where that gets to be too big and it's too much to handle within our government. We have a new administration coming in or a new old administration coming in. It will be interesting to see what happens in this area over the next couple of years. Um, really, it's not hard to expand government. It's really easy to shrink it. I'm sorry, it's really difficult to shrink it. And that's going to be interesting to see what happens in the years ahead. Also, tariffs. I know tariffs are on a lot of our minds because tariffs can be bad for the economy. If you're putting tariffs on incoming goods and services, and we still import a whole lot of stuff from other countries. So if we're making those goods and services more expensive as a way to protect American companies, which can be a good thing, but that's a really good way to create inflation. Tariffs are not necessarily good for the overall economy, but they do serve a political purpose in the geo-economic world. um, but we've talked about tariffs before in the previous Trump administration. My suspicion is that tariffs are probably more negotiating tools than anything else. So we'll see what happens there. Okay, let's talk about maybe some more positives here. And some of these positives are also the negatives that we just look at. The Magnificent Seven, that's a positive in large part because those are companies that are reshaping our economy. Now, some of you might say that's for better or for worse, but whenever we have technology revolutions, from our cell phones to the personal computer to the internet, on and on and on. All of these things have fueled our economy for decades now and created a massive amount of wealth. The more new stuff that we innovate and invent and implement in our economy, making our lives better, easier, more efficient, that all creates economic growth. It creates wealth for investors, and that's a positive. So this is the positive part of the Magnificent Seven. is they are expanding our economy in a significant way. Artificial intelligence, continued expansion of the internet, and so on. That kind of goes into the next year. Part of what happened in 2024 is I think the market is so wrapped up in artificial intelligence and what this is going to be and how much economic activity that's going to create. And it's kind of exciting. Personally, I'm not a fan of all of this AI stuff. I think we're all nervous about it to an extent, or maybe to a large extent. But at a minimum, it is going to grow our economy and create new jobs, new wealth, and so on. Satellite networks, I mean, Elon Musk and his SpaceX program, they're launching rockets pretty much once every 3 days now, returning them to Earth and having them be caught into a stand so that it can all be used over again. Extraordinary stuff. And a lot of what's happening is those rockets are being launched to continue to build a massive network of satellites that will make our cell phone coverage, our communication, our processing, hopefully that much easier, more effective, more efficient. And we continue to have healthcare advances that create wealth because it changes people's lives and enhances people's lives. The new administration has pretty much promised to extend the 2017 tax cuts. The market's going to love that. The question is how are they going to do that? Is there going to be more? We don't know what that's going to look like, but it seems pretty certain that those tax cuts passed in 17 that were set to expire at the end of this year, those are going to get extended. The market will like that. As interest rates continue to come down, even if it's 2 interest rate deductions next year, then in 2026, maybe we see another 2 to 4 reductions. So eventually these interest rates are going to fall, but as long as inflation is still a threat, that'll get slowed a little bit. We'll get more news on that on Wednesday. These compressed springs that are out there in the small cap or small company realm, mid-sized companies, other companies in the S&P 500, we talked about that. This might be some real growth in the stock market here that we're not seeing much of so far, but they will as the economy maybe continues to recover out of COVID, from inflation, from interest rates. We could see some real expansion there in various other parts of the stock market. I also threw the housing market in here. We haven't talked about this much, and then I'm going to kind of finish with this. But the housing market is interesting because, as many of you know, the major recession that we had in 2008 was a housing crisis. What happened there? Well, a lot of people argue about that, but ultimately, if we put it in a nutshell, we were lending too much money to people that really weren't in the business of borrowing that much money. So we were forcing money on people, and they went out and bought homes that they really couldn't afford, even though we were willing to give them a mortgage for that. And that's, you start down that road, and that's going to have a bad ending. And that's exactly what happened. A lot of mortgage defaults, a lot of bankruptcies, which led to bank closures. And that was just a real mess at that point. Now, what's happened since then is our population continues to grow. People got back on their feet out of that again. But I read articles on this that generally our population numbers suggest that we should be building about 1.5 million homes a year. Why do we say that? Because that would keep up with our population growth. We are not seeing those types of numbers. I don't quote me on this, but I think last year we came in at about 1.2 million, and we've been below that 1.5 million line for a long period of time. So homes are not being built at the rate that our population is growing, which puts more demand on current homes. But the problem is there's still a lot of sellers that don't want to sell their current home. Why? Because they have a 3% mortgage or less on their house. So who wants to make a move out of that? So I feel like we're building a bit of a housing boom here again. Number one is because it seems like with population growth, that eventually has to move more. If we're not building more homes, then where are people living? Yes, we have more multifamily units that we build and so on, but the average American probably when they're in their 30s, 35s, 40s, and beyond, they don't want to be in a multifamily unit. They would rather have their own home. But if we're not building enough of them, that's going to create a lot of demand, which is eventually going to build some momentum. So the housing market is a huge part of our economy. And actually, as maybe we see new constructions pick up as interest rates fall, I think there's going to be a lot of activity in the housing market. And that tends to fuel our economy more than a lot of things. And the housing market is very, very important. So, um, it's good news and bad news in this. If you're at basically a lot of analysts, if you ask them and or poll them, give us about a 25% chance of having a recession yet, and probably this year, starting sooner rather than later. That's down quite a ways. But I want to caution people that I don't think we're necessarily out of the woods yet with all of this stuff, inflation, interest rates, all the stuff we've been talking about. However, the fuel of artificial intelligence and other things that are stimulating our economy might be counterbalancing a lot of the threats that we see in the economy. And that might keep us out of the recession. So that's good news. Recessions are not something to panic over. If we have one, I don't think it's going to be severe, but I just think that we did something extraordinary. And generally, economically, with every move that you make, especially as extreme as that was, pumping that much cash into the economy, then usually there's a counter reaction to that, and it may not necessarily be a good one. So I will end there. I hope that this was helpful. I'm going to switch over to my inbox just to see if we have any questions out there. Might have to start offering money for somebody that actually sends questions in. So I don't see anything in here. So I'll just give this a second yet. But again, if this was helpful to you, whether you do it now or tomorrow or whatever, send me feedback by email, letting me know, was this helpful? Was it not as helpful as it could be? And if that's the case, then let me know how this can be more beneficial to you in the future. My overall outlook in this economy is our economy is extraordinary in how it just continues to endure and act in a resilient way even when the economic waters get to be pretty choppy. If we get through this whole thing without a recession, that is a major testament to our system, our economy, and the American corporation, in my opinion. Because as we continue to innovate, come up with new ideas, things that make our lives better, more efficient, that creates growth, it creates jobs, it creates profits, which is all good for investors. And that might be the thing that saved us from the recession that I've been talking about for over 2 years. So, with that being said, I don't see any other questions coming in. So, I hope that this was helpful. Otherwise, have a great evening. Stay warm this week. And I look forward to seeing all of you sometime in the near future. Thanks so much for participating tonight.